Good afternoon and welcome to the HHM Employee Retention Credit webinar. Thank you for taking part of your Friday afternoon, probably for most of you, your lunch hour, to join us. We're looking forward to spending about 45, 50 minutes with you going over the Employee Retention Credit, how you can qualify, and also looking at maximizing the amount and the benefit. So today you have with you myself, John Paul Davis. I'm a partner with HHM, and my colleague, John Egger. John has really taken the reins here and created a lot of our workbooks and support for this. So we're very appreciative of his efforts. He's going to join in, provide some examples, and help us add some color to the presentation. Also, before we get started, I want to make sure we go over the format. It's going to be a little bit different than how we've done this in the past. Please send in questions to the chat function. We are going to aggregate all of your questions and also questions that you email to us. We've got an email address set up exclusively for this credit that you can use. It's ercsupport@hhmcpas.com. And don't worry, this will be on the last slide of our presentation. We'll leave that up for a minute or two at the end of our presentation. Of course, you can email any of your trusted HHM CPAs, and they will get the questions to us, and then we will follow up after this webinar with a copy of the video, a copy of the slide deck, and then a copy of the questions and our answers. Part of the reason we're using this format is some of this guidance is recent and evolving and changing, so we want to make sure that we take the time necessary to provide a thoughtful and complete answer. And then for some of you on your questions, we'll reach out to you individually as those could be very specific questions. So anyways, just wanted to make everyone aware of that. So at the end, we will not be going over in live the questions and answers. Rather, we will follow up with those items. So let's jump in. To begin with, so this webinar and everything related to it is based on our understanding today of the language in the legislation and the guidance that has been provided. We recommend that you work with your legal or other professional advisors specific to your situations when you're applying for this credit and claiming it. On our agenda today, we'll have an overview, then we'll jump into the qualifications, how to calculate the credit. There's a lot of interaction necessary with the Paycheck Protection Program loans. So if you have or are contemplating this loan, maybe even round two, we'll go over how that will affect your application for the ERC. Then we'll look at how do you claim the credit. We'll go over other items to consider, which are really the items that we thought were important that affect your calculations throughout. And then again, at the end, that question and answer slide will be the specific email address that you can send in your questions, and we will follow up with answers. So let's jump in. What is the Employee Retention Credit? So this credit was created under the CARES Act of 2020. And most of the CARES Act seemed to have been focused on the PPP loan program. A lot of press about it, a lot of benefit. A lot of our clients applied for it, but also within the CARES Act, you had to specifically choose either the PPP loan or the Employee Retention Credit. You were not able to do both. So I think that's one of the reasons why the Employee Retention Credit was not as prevalent in the public mind. This credit was then amended and revised in December of 2020, which then removed that restriction. You could apply for a PPP loan or have already had a PPP loan and also apply for the Employee Retention Credit. It also expanded the credit from a 2020 year credit to include the first 2 quarters of 2021. Then on March 1, the IRS released anticipated guidance, which was specific to the 2020 credit. And we'll go over how those two are different. However, we're expecting additional guidance, so just please note that for 2021. But I believe that we can look to the guidance for 2020 to give us a pretty good idea of what we can expect. Then just yesterday, our president signed the American Rescue Plan Act of 2021, further extending the employee retention credit through the last 2 quarters of 2021, and also allowing for additional eligible employers. We'll go over that a little bit more. The purpose of the credit, what is it? In my mind, it has the same underlying theory or the same reasoning behind the PPP loan program, which was in times of crisis in this pandemic, with loss of revenue for many of our clients and throughout the entire economy, there was a need to help employers retain their employees and for employees to retain their wages. So where the PPP loan program did that through a loan that had restrictions and restrictions to the use for payroll, this employee retention credit is if you continue to pay your employees or you retain them, you can then get a refundable credit relative to those wages on your quarterly payroll tax forms, Form 941. So changes from the original, we've touched on this already a little bit. You're now eligible if you've received a PPP loan, and then also it's extended through the entirety of 2021 now. Let's look at qualifications. What is an eligible employer? And John, before we jump into the distinctions between large and small employer, I believe correct that every employer is eligible. Your distinction is whether you're a large or small employer. Is that right?
Yes, with just a couple small modifications.
That's right. So, and then also it was expanded to include all 501c organizations that are exempt from tax.
Correct.
So the difference, the distinction, and we'll talk about how the credit is calculated differently because of the difference in qualified wages. Just keep in mind, there are 2 credits here. One is the 2020 version, and then one is the 2021 version. And the distinction between whether you're a large or small employer is different for 2020, and it's different for 2021, and it's based on your full-time equivalent employees and how many. So for 2020, if you have over 100 full-time equivalent employees, you're considered a large employer. For 2021, it's been expanded. So if you have over 500 full-time equivalent employees, that's considered a large employer. Slight difference. I think we're all used to this FTE or the full-time equivalent employee calculation, especially for the PPP loan program. And that was based on a 40-hour week. This ERC is based on a 30-hour week. So we'll need to, if you're relying on that calculation that you use for the PPP loan application, we need to tailor it a little bit and recalculate. You could have more full-time equivalent employees simply because you're using a 30-hour week instead of a 40-hour week. Also, the calculation period is 2019. So if you were in operations during all of 2019, when you're looking for the 2020 or the 2021 credit as to whether you're a large or small employer, you need to refer to the average number of FTE employees during 2019. Of course, if you started mid-2019 or even in 2020, your operations, there are different calculations, and we can work through that with you. So just keep that in mind, large or small employer, as we're going through this. Now one other thing, we'll touch on this in the other items to consider, but when you're looking at a single employer, you might need to consider a control group. There are restrictions around this. If you have an organizational structure with multiple entities, multiple LLCs or corporations, but they're under common control, whether through parent sub or a brother sister type of structure, you might have a single employer for every entity. So we'll go through that. Of course, if that's your situation, then work with your professional advisor to help you make that determination if you don't already know the answer. Let's talk about ineligible employers. The eligible employers have been expanded to include some governmental entities. So on the flip side, some governmental entities are ineligible. If this is you, if this is something that this is a bracket you would be included in, you need to then look at the specific rules, and we can help you understand that as well. The PPP loan program allowed for self-employed individuals to count themselves as employees and in the wage base to determine their loan amount. This is a little different. Self-employed individuals that have no employees on payroll are not included in the Employee Retention Credit Program. If a self-employed individual has employees, you could use those employees as part of your qualified wages. Now, on the flip side, let's just make sure we're on the same page here. This is all based on employee-employer relationship. So if you have a 1099 contractor, this program just simply does not apply to those payments. Let's look at the qualifications. So there's a two-step, and it's an or type qualification. So it's one or the other. Now, this is pretty intense in that there are different periods that each cover for the wages that are included under each. So you really want to consider both. However, if you are qualified under one or the other, you qualify. So the first metric is the full or partial suspension. In short term, people have been calling it shutdown. We're using that shorthand, but the more technically correct phrasing for this is full or partial suspension of your trade or business operations. That could be through a government order, either federal, state, or local. And then if you have a partial suspension, that brings up what if it's a more than nominal portion of your operations are suspended, right? So that's a bit of a gray area. We've seen a lot of look on this, especially from there seems to be a whole new cottage industry of advisors that are reaching out to our clients and offering to help on this and automatically qualifying them through this nominal portion of operations. But it's going to take a little bit more digging to make sure that you qualify. This could be simply, I use the example of a grocery store, restricted hours. That could be a partial suspension of operations, or the food bar was shut down in the grocery store. And so is that food bar more than a nominal portion of those operations? It's really a look at the gross receipts for the total organization versus what has been affected or impacted within it. So we've seen numbers such as 10% of, if the nominal portion of your operation is more than 10% of your total revenues, then or total operations, then you're considered as being impacted. Now, that could be an easy metric to hang your hat on, but in my mind, you really need to take a deeper dive and make sure that you qualify based on that nominal portion of your operations. So if this part of this test applies to you, your qualified wages are the wages paid during that partial suspension or that full suspension. So if you were impacted for 3 weeks, no matter what quarter they're in of 2020, those 3 weeks of wages qualify under the ERC. Slightly different. We're going to be focusing a lot on the quarterly gross receipt decline, but keep in the back of your mind, if you're hanging your hat on the full or partial suspension, the qualified wages are for the time period that you had suspension. So last year in 2020, we had orders that were placed, that were put in place, and then those were lifted and then put in place again. So when you're looking at 2020, you could have a section of time in maybe March or April, then those were lifted, and then another section of time in maybe June or July when more restrictions were put back in place, and then maybe in the holiday season of November. So if you're looking at this, it could be sections of weeks or months, however that applies to you throughout 2020. Okay, let's jump into the gross receipts. This is different. This is a quarter by quarter comparison. So if your quarter of 2020 compared to quarter of 2019, comparable quarters. If the gross receipts from 2020 are 50% less than the same quarter's gross receipts in 2019, then you qualify for all wages paid during that quarter. So a little bit different. It might be harder to qualify because the impact here of 50% decline is a high level of impact. However, you do then qualify for that entire quarter and potentially for quarters after that. We'll dive into that. Let's look at the difference for 2021. So going forward in 2021, if you've had a full or partial suspension of trade or business operations, same sort of thought process as in 2020, same time period, you could qualify in 2021 for those weeks where you have partial suspension or full suspension of your operations. Now, the big difference is between your quarterly gross receipt decline. Your quarter by quarter comparison of 2021 quarter to 2019 quarter, your decline percentage is only 20%. And if in the back of your mind, you're thinking, well, wait, I don't have a comparable quarter in 2019 because I started mid-2019 or at the end of 2019 or mid-2020. Don't worry, you can still do your comparison. It's just a little bit more complicated, and we'll go over that in a bit. Let's talk about government orders. What qualifies as a government order to shut down? So it could be non-essential businesses that were ordered to shut down their operations. It could be your essential business, like that grocery store that had a nominal portion of its business operations suspended. So it was not able to continue its operations as it had before the pandemic. It could also, this is one that might open up this bracket to other clients. Businesses who are impacted due to their suppliers having suspended operations. So I know a lot of our dealer clients had issues receiving either parts inventory or vehicle inventory. So could that be an impact on their operations? And again, here it would have to be in a more than nominal way. Of course, you could also consider your government orders to reduce hours of operations as part of those government orders that qualify you for, and again, here I'm using the term shutdown, but it's really that full or partial suspension of operations. Let's talk about clear distinctions for what is not qualified as that order. If you've got a press conference or a statement from the CDC or your local government for recommendations, that does not qualify as an order. You could have businesses that remain open that are not shut down or their hours were not restricted, and for whatever reason, their customers are not coming to the business for various reasons. Here we've got for stay-at-home orders. The overall effect here is a reduction in demand for that business. So that does not qualify a government order. What it does is would perhaps require that business to pivot towards that revenue reduction metric, that gross receipt reduction quarterly comparison. If you voluntarily suspended your operations, that also does not qualify as a government order. Even if you were relying on a CDC statement or other statement, it has to be an actual order from the government. If you had a government order that did suspend your operations or have an impact on your operations, however, you were able to continue through telework, then that would also not constitute that order to suspend. You would not have that impact because you were able to continue your operations through telework. So let's talk about that telework. I think this is going to be a really interesting question for a lot of our clients. You need to consider various factors that then help you understand whether you were able to continue that telework. Did you already have the infrastructure, the technology in place pre-pandemic, and was it a smooth transition, or did you have to create it? That could be a factor in your decision to looking at full or partial suspension. What is the need for the presence in the employee's physical workspace or the portability of that work? Is it even possible to move towards a telework environment? And John, could you add an example for that? Like how would this apply in the real world?
Yeah, so one that let's say Telework really would work for and kind of kick them out of the government suspension would be like an accounting firm, such as us, a law firm. We were able to shut down or in March.
Transition, right?
Yeah, we were suspended for March, but we were still able to take our work home, still work. There were no real suspension of operations. Everything still got
There was an
done.
impact, but we were able to continue our work through our teleworking ability.
Correct.
Right?
And then let's look at somebody like a physical therapist. Physical therapist might be able to do part of their work through telework, meet with clients over the phone, through things such as Zoom. However, they don't really have the capability of their office to really get in the equipment, to be hands-on with their clients. So their clients don't get the full service that they would expect from their physical therapist.
It's hard to take an X-ray over a Zoom conference. Is that what you're
A
telling me?
little hard.
Okay. So but to summarize though, all these factors, it's going to be specific to your operations as to how that would be considered and then also documented. Throughout this process, when you're going through it, we'll touch on documentation at the end of the presentation, but if you're going through this thought process, we need to document how you came to that conclusion. It might look a lot like that qualification and need for the PPP loan program. You might have to do something similar when you're considering, you've got to build your story, your narrative as to what you needed to do to transition to life under the pandemic. Let's talk about multiple locations and how that could work. And again, remember in the back of your mind, employer could be an aggregated group or an aggregated group of various entities under common control. So let's talk about an employer that has multiple locations, maybe in different states. Some states were more restrictive, some states were less. If one of their locations was impacted, we've got the word shutdown, but remember, full or partial suspension of operations, then if only one was impacted and the rest of the locations were not, the entire entity is considered as affected. So you don't have to do a carve out of the wages for the one location, which is helpful. You should consider location by location basis. However, remember, you could be required to file as a single payer if you're an aggregated group, and that could change whether you file as a small or large employer. Okay. Let's jump into the decline in gross receipts. All right. So for 2020, if there's a decline of 50% of the gross receipts compared to the same quarter in 2019, you qualify. Now, remember, it's different for the full or partial suspension because that is just for the weeks that you were impacted. Under this guidance, though, the entire quarter is eligible. And that continues until the following quarter, whichever that is, the immediately following quarter or the next one after that, until you have a recovery where your gross receipts compared to the same quarter in 2019 are greater than 80%. So let's give you an example. Let's say your Q2 2020 wages, or excuse me, gross receipts, your Q2 2020 gross receipts were less than 50% of the Q2 2019 gross receipts. That Q2 of 2020 is now eligible, all those wages paid within 2022. Q3 is also eligible, even if the gross receipts in Q3 of 2020 compared to the gross receipts in Q3 of 2019 recovered to about 83 or 85%. You're still eligible. However, Q4 then drops off, it resets. The only way that Q4 is eligible under the gross receipts test is if Q4 then drops again below that 50% line. I know that's a mouthful and a lot to consider, but we can help you work through that and help you run those calculations as well. Remember, your aggregated groups are treated as a single employer. And so that gross receipt test is for all the members of the aggregated group. That's an important distinction. If you're a tax exempt employer under that 501c bucket, gross receipts also include contributions, gifts, and grants. There are other items to consider, and if you're in this bracket, reach out to us. We can help you calculate that gross receipt number. Let's look at what happens you started or acquired your business in 2019. So you would use a rolling quarter comparison with the first quarter of operations in 2019 as your comparison point until you had that corresponding 2019 or 2020 quarter comparable. We can walk you through that, but essentially you've got that rolling quarter. If you start in the middle of the quarter or a partial quarter, you need to use a reasonable method to essentially, it's not annual, quarterlize. I just created a new word to estimate the gross receipts for that entire quarter. What if you acquired your business in 2020? You would then use the quarter by quarter basis comparing. You could actually use the historical not gross receipts of the entity before it was acquired. Essentially, you're the successor entity, whether you acquired substantially all of the operating assets and operations, or if you purchased the ownership interest themselves, you can rely on the historical gross receipts of the entity before your acquisition. Let's talk the 2021 guidance. So on this one, it's slightly different. Remember, you've got the decline of 20% of the gross receipts compared to the same quarter in 2019, or the quarter immediately that's preceding that quarter. The analysis is per quarter, okay? So this is different. Whereas in the 2020 calculation, if you qualified, you then rolled to the next quarter until you saw a recovery. In 2021, you're going to run this calculation every quarter. So Q1 of 2021, you're going to look at your comparable. Did you have a decline of more than 20%? Q2, you're going to do the same math. Q3, Q4, so on. So similarly to 2020, aggregated groups treated as a single employer. Got to consider your gross receipts for everyone in the group. And then the same thing with your tax exempt employers. Let's look at the calculation of the credit. So, John, what's the maximum credit amount for 2020 and 2021? And then can you walk us through with the presentation here an example of how, the wages, what's included in wages, and how that credit's calculated?
Yeah, for 2020, the maximum credit per employee is $5,000. You can take up to $10,000 of qualified wages, and the credit is actually 50% of that on an annual basis. So as an example, the first employee listed below has $1,000 of qualified wages and $500 of healthcare costs. That gives them a total of $1,500 of wages that can be used for the credit. So you would take 50% of that and gives you a credit of $750. So that would just be for quarter one, and you would do that each quarter that you are eligible up to a maximum of $5,000.
So to be clear, in 2020, you could have the credit calculated in more than one quarter. However, the maximum credit for the entire year per employee is $5,000.
Correct.
So 2021 is a little bit different, isn't it?
Yes.
Can you walk us through that? 2021
is a quarter by quarter basis with a credit of $7,000 per employee.
Per quarter.
Per quarter. So for example, quarter one, employee gets $10,000 of qualified, or has $10,000 of qualified wages. You take 70% of that for a credit of $7,000. Then again, in quarter two, if they had $10,000 of qualified wages, you would take 70% of that again for another $7,000. So up to $14,000. And you can do that each quarter up to a maximum of $28,000 per employee.
Now, assuming this all assumes that you qualify quarterly, either through full or partial suspension or through the gross receipt test, and that is for the entire quarter. Remember, full or partial suspension is not necessarily the entire quarter. And as long as your employees have $10,000 per employee of qualified wages, and as long as that is in each quarter, you could have a maximum of $28,000. Now, granted, I hope your takeaway is not that there's $25,000 available per every one of your employees. That is, if all of the stars align and this is applicable to you, this could be the situation that you're looking at. Let's talk about the qualified wages. This is going to be important. And remember, we're going to jump into this. It's pretty important that you also consider, and we'll go into detail on this, but there are other benefits and programs such as Work Opportunity Tax Credit, WOTC, the family leave payments that were available under the Family First Coronavirus Act, also PPP loan program wages that were used for your forgiveness application. Those are carve outs. We cannot, I need to stress this, we cannot use the same wages for more than one credit. So if you're going through and you've received, one of these 2-page forms from a specialist of this ERC credit, and they've calculated, or your payroll provider estimates that you could have X number of credit dollars, did they go through the exercise and remove the wages that were included on your forgiveness application if you had a PPP loan program? I'm not sure. That you need to be mindful of the numbers and figures that are being thrown about, because a lot of these qualified wages might not be available. So, and then also the other thing I'll mention, we've seen a lot of just ads and prospectus around this credit where they're including all of the payroll for the entire year, regardless of whether a quarter qualifies or whether it's just a 2-week partial suspension of operations. You've got to, one, qualify what time or partial part of the year is affected. And then also then within that bucket, what qualifies as wage, and has that wage been used for another purpose? It's highly important. All right, so let's jump in. So your qualified wages is compensation. It's compensation paid to your employees. That can look at several different ways. It could be commission, it could be base salary, it could be hourly, it could be salary. The IRS was specific. It does not have the consideration of Social Security wage base. That's where there's a cap as to the wage base that is taxed under Social Security. They're essentially what they're getting at is, remember, under the PPP loan program, there was a cap of eligible wages of $100,000 on an annualized basis. Here, there is no cap other than the $10,000 per employee per quarter in 2021, or the $10,000 per employee for all of 2020. Included in there are expenses, qualified expenses for health plans. We can help you work through that. Not everything within that bucket is included. However, just keep in mind, both employer and employee pre-tax portions are included. Qualified wages. I touched on this earlier. You don't include the qualified family leave wages or those credits that were applied, that you essentially, whatever wages that you have received a benefit for, hit pause, reach out to your professional advisor. All right, so the qualified wages, you're probably wondering, why are they making the distinction of a large employer versus a small employer? Here it is. Here's the distinction. If you're a large employer, you cannot claim the credit for one, on an increase in wage while the employee is not providing services. So that's one, and here's why that distinction is important. If you're a large employer, your qualified wages are only the wages that are paid to the employees when they're not actually working for you. They're not providing a service, okay? So that one I've got to wrap my head around. So if you are a large employee, you've got that full or partial suspension of operations or the decline in your gross receipts, the only wages available to you for this credit are the ones where your employees are not actually working for you. They're not providing a service. So that is restrictive. If they're at home teleworking, they're providing a service. They don't count. You cannot include those wages in there. And this is why I would also strongly caution against just using that, that let's just run our payroll register and calculate the credit. There is more work to be done to see what is a qualified wage and what is not. Again, I touched on this briefly, the increase in wages. If you're in that situation and your employee is unable to work for you and you're a large employee, you cannot maximize, I like that they actually have this in the guidance, but you cannot maximize your credit by simply increasing the wages paid while they're not providing service. You've got to look back at the 30-day average of compensation before the suspension of your operations or before you were qualified to look at the credit. Vacation, holidays, sick days can be included for the small employers. However, your large employees, you cannot include these. So if your employee, because they're suspended, unable to work, elected to take vacation days, those do not qualify. So, there's just, and I'll stress this one more time, there's just a little bit more work to be done before we hang our hat as to the amount of available credit for each of our clients. Let's talk about the interaction of the PPP loan. So if you have this PPP loan, which in my mind is probably the largest bucket that we need to really be concerned about as far as separating or delineating the qualified wages. If you are now allowed to consider the ERC, if you have the PPP loan, which is a change from the Taxpayer Certainty and Disaster Tax Relief Act, like how long that is. But here's the difference. You then have to go through and look at your forgiveness application, and the wages that were utilized to obtain forgiveness need to be removed from your employee retention credit calculation. And unfortunately, the IRS's guidance here is that you can't change your application, and if you didn't include non-payroll tax items on your application, you then have to consider that all of the wages listed on the application up to the amount of loan amount are considered removed and unavailable for the ERC, even if you had non-payroll costs on during that covered period for your PPP loan. And this is hugely frustrating because we've seen a lot of our clients and a lot of just businesses simplify their forgiveness application by relying on the payroll items because for whatever reason, documentation, was it simply because for the 24 weeks there were enough wages to more than cover or apply for forgiveness. If you didn't list, or if you have not yet applied for forgiveness, maximize your potential for ERC by listing as many non-payroll costs that are available to you. Now, granted, under the PPP loan requirements, 60% of the loan forgiveness amount must be payroll, but I would highly recommend that you consider including non-payroll items even if you don't need them, because the IRS is highly restrictive. You've got two examples in their FAQ where if an employer, the same employer, if they did not include, or they did include, the ones that did include non-payroll items on their application for forgiveness have essentially, I'll just call it preferential treatment. And anyways, I can't stress enough how frustrating this is, but that's the guidance as it is now, and there's no, currently there is not a way to amend your application for forgiveness. So if you're considering an application for forgiveness or considering how to do this for round 2 of your PPP loan, really focus here, if you can, take advantage of the ERC credit, how you apply for forgiveness, and how you then separate out wages for one or the other. We've got an example for you. If you look at employee number 4, $10,000, $11,000 of wages, all of that was used on the PPP loan application and used to apply and receive forgiveness. Then the Q1 credit would be 0. Employee number 3 was not included on the PPP wage amount used for forgiveness, so then they would then be eligible to receive the ERC to the full amount. So let's talk about how do you claim the credit. So for most of our employers, Form 941 is how you're going to use, well, really for everyone, I would imagine. Yep. Form 941 is your quarterly payroll tax form. We'll show you on the form where these items are either calculated through the worksheet or where they line up on the actual form. Here's where it gets a little tricky. 2020 has already happened. I hope all of our clients have already filed their 2020 quarterly Form 941s. So to claim this credit, we need to amend these forms. The problem with this, and you have up to 3 years from the date you filed to amend your return, so we've got some time. But the problem is These payments are then received, or the refunded amounts are received when you when when your amended form is processed and the IRS agrees and they send you a check or a direct deposit. The problem is, I read an article yesterday that the IRS is opening up mail from July of 2020. So if you send in your amended 941X in, was it March 12th of of 2021, they open the mail first come first serve. So we're hoping to see some relief here, where we can maybe utilize either the advanced payment form, something that would help. However, current guidance right now is we need to file an amended 941 for the 2020 credit. Of course, going forward for the 2021 credit, we can take it on the payroll form when we file it. You could also use Form 7200, the advance payment of employer credits. For 2020, it's been allowed, which I love how the IRS is doing this, but they're allowing advance payments for the past, which I'm still trying to wrap my head around. We are expecting that this form could be used in 2021. However, stress this, it's pending IRS guidance allowing that to happen. So just remember, you claim the credit on your quarterly payroll tax form. It is not on your business tax form. It's not on your annual federal tax return. It's on your payroll tax return. And it could be through an amended form. This is an example of your 2021 941. You'll see line 11C is the non-refundable portion. There's both a non-refundable and a refundable portion. The non-refundable portion is simply you have collected payroll tax from your employees, and then you are then going to pay in. You might have already done it on a weekly basis, your payroll taxes. You then reduce what you would pay with your quarterly return. You would just simply retain those payroll taxes if applicable. And then the difference could then be refunded. If you look at your worksheet 1, step 3, you could go through that calculation to calculate your non-refundable portion, then of course your refundable portion. This, like any tax form, can be confusing. Please reach out to us. We can help you work through this and either amend your 2020 or be in a good spot to file your first quarter or second quarter 941s appropriately. Let's talk about other items. So your qualified wages are going to, the big question is always, how does this affect me tax-wise? And we saw the debate and the change in guidance relative to the PPP loan program. So I expect with the ERC program getting a lot of attention, there could be changes here. However, as it stands, the wages that you use to claim this credit are going to be reduced by the credit amount when you report it on your federal income tax return. So let's work through that. If you have employee wages of $10,000 and you're able to receive the $5,000 credit for 2020, your net wages on your federal tax return are then $5,000. So there is an income tax effect. It's not income. It's not additional income. It's a reduction of the expense, which I think is hilarious that we have to specify that because it's the same thing. It's not income, however, it's a reduction of the expense. Now, current guidance is that you have to reduce the actual wages by the credit. So if you've already filed your 2020 return and you're looking at amending your 2020 quarterly payroll tax returns, we then could have to consider amending your 2020 tax return to reduce the qualified wages on that return by the credit that you receive. We are hoping that the IRS provides relief to this because there are exceptions that were enacted for WOTC, allowing the credit to have the tax effect either when applied or when received. And so it would be extremely beneficial if the IRS also allowed that for this ERC credit. We are hoping, again, we're hoping that if we amend 2020 credits, we then pick up the tax effect in 2021 when we receive the credit. However, if you are in this category, you have not yet filed your federal corporate return, which is due for flow-through entities on Monday, the 15th, I highly recommend that you extend your return. If you're considering this credit, extend your return to give yourself enough time to make sure that you don't need to affect your 2020 reported wages. All right, so there is the possibility of receiving an advance credit. Let's stress that. The ERC is a refundable credit. Let's stress that. Remember your aggregation rules. All entities of the control group, affiliated service groups, work through that. We can help you with that. And then last bullet point, we've got some wages to related individuals. If you're related and you fall in that category, let us know. We can help you work through that as well. Documentation, I know I'm coming up on an hour and I apologize. Let me just wrap this up. Of course, this slide deck will be available for everyone. If you do not have to provide this documentation with your 941. You have to keep this documentation for 4 years. And the intent here is to document your reasoning behind the government order. Do you have a copy of the order? How did you calculate the nominal portion of your operations that were suspended? The records for the wages, how you calculated, whether that was PPP wage or family medical leave wage or ERC wage. You've got to show how you calculated your aggregated group, how you determined what entities were included or what entities were not included. And then you also have to document, if you're a large employer, what wages were paid when your employee was not providing service. So I know that's a mouthful, and essentially what it is, I'll stress this, you don't need to provide this documentation with your quarterly tax return. However, if you are audited, this is a list of the items you will need to provide to support your calculation. So remember, this exercise is important. Keep it in your files at least for 4 years. Again, I know this is a lot of information. I really appreciate your time. Thank you for sticking with me. I just have a couple wrap-up comments. This email address, ercsupport@hhmcpas.com, will be available going forward. Please send in your questions. We will try to include them on our FAQ sheet when we distribute this video and slide deck. Thank you for your time. One other thing I want to touch on this real quick is I know there have been a lot of our clients have received these 2-page or 1-page flyers telling them how much of a credit they can receive for a small fee and then a percentage of the credit. I'll just throw out, just remember when you're going through this, if you have someone that's offering to run this calculation for you and they're going to charge you a percentage of the credit, there is incentive to increase the credit because that affects their payment. The other thing I'll throw out there is the responsibility could be entirely yours as the business owner, as the person filing and signing this return, that it is complete and accurate. For the most part, these advisors are offering to maximize or increase the credit, sometimes incorrectly. They will get paid a percentage of that credit. And then if it's audited, it's 100% your responsibility if there is an adjustment by the IRS. So just be mindful of that, be careful. We're available to help. We do not charge success fees, and we can help you reason through this and make sure that your applications are created appropriately and in a manner that follows the guidance and the rules in the law as enacted. So again, thank you for your time. Please send in your questions.